Exactly. Okay, we're going to start this hour with the economic fallout from the coronavirus and particularly the Fed's emergency interest rate cut. It was the first such reduction since the financial crisis back in 2008. Fed Chair Jerome Powell acknowledging, though, the limits of monetary policy when speaking with reporters right after the cut.
We do recognize that a rate cut will not reduce the rate of infection. It won't fix a broken supply chain. We get that. We don't think we have all the answers. But we do believe that our action will provide a meaningful boost to the economy. More specifically, it will support accommodative financial conditions and avoid a tightening of financial conditions, which can weigh on activity. And it will help boost household and business confidence.
Markets, as you know, plummeted right after yesterday's 50 basis point cut to ending the day down more than 700 points and continuing an ugly week for equities, say for Monday. Things look to be turning around this morning, but Steve Leisman joins us now with more on what the Fed's rate cut can and can't do for the economy and those nervous about the coronavirus.
Thanks, Andrew. Our flash CNBC Fed survey finding Wall Street thinking that on balance, the rate cuts are a positive but won't be enough to address the total economic fallout from the coronavirus, as the Fed chairman just said. A strong 62% majority approve of the rate cut, 25% disapprove, but only 32% believe it will be even somewhat effective. 43% say it will be slightly effective. 23% think it will not be effective at all. Still, another 50 basis points of rate cuts are expected from the Fed this year, and 35% of respondents think the Fed could go to zero in the next 12 months. Lindsay Piega, chief economist at Stifel, writes, buckle up. Yesteryear's low-rate environment may seem like high stakes compared to the reduced interest rate environment on the horizon. Even after the rate cut, the probability of recession in the next 12 months surging to 41%, a record in the 9-year history of the question. If Joe Kernan was live commentating, he would point out 59% probability of not a recession in the next 12 months, and that would be fair. Commentary accompanying the survey was mixed in its assessment of the Fed. Joel Naroff from Naroff Economics writes, they botched both the timing of the move and the messaging by making an emergency action. It sends the message we're in an emergency. But Kathy Bostjanek of Oxford writes, quote, while not a virus panacea, it does provide some support to the economy. Forecasters estimate the coronavirus will shave 0.6% off growth this year. They see rebound, which I think is a low number, of just 0.1% next year.
I was actually trying to, I heard what you said and I didn't understand. Ending the day down more than 700 points and continuing an ugly week for equities. We're up 1,300 on Monday. We're down 700 yesterday.
Wait, let me do the math.
That's someone that just thinks things are horrible, and
it depends how you think about it. The past 7
days, that's not what we meant.
That's the last week.
We said save for Monday. Okay, if you want to do 5 trading sessions, okay. But remember on Friday we did come back about 700 points in the last half hour. That was pretty unbelievable.
That's true too.
All right, so we're okay.
I love you looking at the glass always.
Well, no, I heard you say continuing an ugly week, and it's like it's Wednesday, number 1, so we only have 2 days. So you can't say save for Monday, and when one is 700 and one's 1,300, just get this right. I'm like Frank Reynolds, we've got to get this right. Anyway.
Steve, thank you.
Thanks, Steve.
That's really kind of you.
You didn't write that.
What, the ugly week?
An ugly week.
No, I did not write that. That's not me.
All right.
The Fed's emergency rate cut was designed to soothe investors, but it ended up spooking them. The 10-year yield dropping sharply yesterday to an all-time low of 0.906%, though it's off those low levels right now. Actually, it's back below 1% at 0.996%. And we were told right here on Squawk Box that sub-1% rates were coming. Who told us that? Kamal Srikumar, who is the president of Srikumar Global Strategies. He joins us once again. Also joining us is Sam Stovall. He's chief investment strategist at CFRA. He joins us with a look at some of the stocks that have the greatest upside potential once the market bottoms. Now, gentlemen, welcome to both of you.
Good to be with you, Becky.
Sri, we have to start with you. When you called interest rates for the 10-year being somewhere between 0.75% and 1%, not only did we give you grief, we had no idea we were going to be there so rapidly. Here you are, same week that you've called that. What do you think?
I didn't expect it to go down so swiftly, Becky. And I think in terms of the sharp fall, we owe it all to a bad move by the Federal Reserve and an even worse press conference by Fed Chairman Powell. We almost certainly can bank on some of the miscues and timings. Essentially, the Fed said They were cutting, but they didn't think it would effectively be put an end to any of the problems for the market, but they thought Mr. Powell said he had to do it anyway. It almost seems as if he was reacting to the presidential tweets and cutting it even though he didn't believe it himself. And that kind of a press conference and statement was a major factor in the swift fall. I had expected it to keep falling anyway, but that it happened so sharply in a few minutes is all due to the Fed and the chairman.
Hey,
do you want him to lie?
Great. I was going to say, look at the economic impact in a place like China and a place like Italy, which, by the way, has just announced that it's going to be closing all schools and universities all over the country because of the coronavirus outbreak until mid-March. I mean, we're watching this happen real time.
Exactly. All of that is happening, and none of that is going to be corrected by the Fed action. What they ought to have done is to say that they have very little to do in this whole process. We need a quick cure for the coronavirus. We need a quick solution, and money should be spent on research, on testing, and not on cutting interest rates.
Although
it does
I think
absolutely
he said
nothing.
that this would offer some sort of a shock-resistant or shock-proof situation, but all those other things had to happen too. I thought in his press conference that is what he kind of said.
Yeah, but on the other hand, Becky, I think he doesn't even remove the shock that comes from it. The consumers were actually shocked. The investors couldn't believe that the Fed was doing an emergency cut, even though Mr. Powell thought that it was not going to be effective. So essentially, he undercut the move, and I don't think there was any boost to confidence that came from the move either. So in other words, it was a total failure.
I'm confused, Sri. Is the move the problem, or what he said about the move the problem?
Both are problems, Steve. I mean,
take it one by one.
They are not mutually exclusive.
So he should have done the move and lied about its effectiveness, or not done the move? I'm confused.
I'm sorry it was not clear to you, Steve. I'm saying that monetary policy is ineffective to deal with the coronavirus, and it doesn't matter when it is done, it is always ineffective. So I'm not saying that yesterday morning was a special day for it to be ineffective. I think the whole process just should not be done. There is no move required on the interest rate at all.
So it's okay for the 10-year to fall the way it fell, even prior to the rate cut, and for the Fed not to validate that and keep its short-term overnight lending rate, what would it have been, like 60 basis points higher than the 10-year?
Steve, I've been saying this to Joe over the last 3 years. The reason the 10-year yield falls has nothing to do with the Fed action. It has to do with inflationary expectations and expectation of real growth. And former Commerce Secretary Carlos Gutierrez said it best an hour ago on this program, talking about the need for immigration of skilled individuals. You need to make structural changes. You need to make training in order to boost the economic growth rate, and that will increase the 10-year yield. Fed has nothing to do with it.
Sam, let's talk about stocks that you think are poised to increase if we've actually seen the bottom.
That's right. Well, we were down 12% at the worst. And basically the question people frequently ask me is what stocks could do fairly well. So I did a simple search on our MarketScope Advisor platform, looking for those stocks that are ranked buy or strong buy that then have very high differential between the current price and target price differential. Interestingly enough, a lot of the companies were relatively small, but a majority of them came from the industrial sector, followed by energy and materials, not surprising. This morning, I also added, looking at some stocks that have very high quality, meaning consistency of raising earnings and dividends over an extended period. So you have companies like Disney, you have companies like United Health Care, Universal Health Services. You also have financials like State Street, JP Morgan Chase, et cetera, where these are high quality companies that have been beaten up by 20% 5% or more that our analysts still believe are good investment opportunities.
That is not necessarily claiming that you think the bottom has been set.
That's correct. I mean, if we take a look at the $173 in earnings expected for 2020, and we come down to a median PE of 16 times, that implies we should be coming down to about 2,800 on the S&P 500, which would represent a 17% price decline. So another 7% from where we are today, 5% from where we were at our low. If, however, we find out that earnings end up being dramatically cut for 2020 and we end up with no growth whatsoever, an even lower PE of 15 would bring us into a bear market territory down about 26% to about 2,500 on the S&P.
All right, Sam, thank you very much. Sri, thank you. We'll talk to both of you again
Becky.
soon.